Hey guys, welcome back to a new video. Today we are going to be doing the analysis of 3M. Now, they recently hit a bottom of $100 per share, and I would love to buy this company somewhere at like 95. See if it's going to get there. It's, of course, a very attractive company with a dividend of 5.5%. And let's jump into the numbers. Okay guys, so this is a $59 billion company, according to market cap. And their revenue is 34 billion, so almost half of their market cap. Their net income is 6 billion and their profit margin is pretty great, but they recently had a dip in free cash flow, and that's why ultimately the stock was going to fall. But also because of overvaluation. You can see the P is 10.3 for the trailing 12 months, and the 5-year P is 16. So you can already see that, of course, the P dropped and the price dropped. Now, the price of free cash flow is a little bit different because the free cash flow had a dip, right? 4K to 4 billion, right? So, but yeah, so the price to free cash flow is still not that great. But the book value per share is 26, and I don't like, with big companies like 3M, 26 is actually not that bad because Apple, which is supposedly a very good company according to all of the numbers, it's trading right now at $160 at the time of the making of this video, and its book value is like $3. Which means that this $26 per share compared to $100 is not that bad, really. They don't have a lot of cash on hand compared to their debt. Their debt is pretty big, and that is the first flaw of this business. Their debt is pretty big, and you can see that their cash minus debt per share is also very big. And then their assets are a lot bigger than their liabilities, which is great. And they have a very nice 5-year return on invested capital. So let's move on to the charts here. So you can clearly see that the revenue is just half of the market cap, and the net income is not that bad compared to revenue. A nice profit margin of theirs. Now let's move on to the payout ratio. You can see that here they were pretty nice in this situation of paying. You can see that their payout ratio was here 60%, then 50%, then 58%, which is good. But then recently the payout ratio went to 83%, 83%, because of the dip in free cash flow. You can see right here. Of course, the dividends stayed the same, or maybe even increased. But yeah, it's not terrible with dividends. Their shares outstanding are also going down, so 10 years from 682 to 566, so great to see that. Their book value is nice. It's growing. Recently just stagnated in the recent years, but what I love to see is that book value is going up and the price is going down, and that's when you usually see buying opportunities, right? So that's great. Now let's move on to the assets and liabilities. So their liabilities are going down and their assets are about the same. So not terrible there. You can see that that's why their book value is growing. They're just decreasing assets because this is obviously smaller than the difference here, right? Now let's move on to the assets. So you can see they have a lot of goodwill and intangibles, which is not that good. Also a lot of property, plant, and equipment, which is okay. But usually we want to see them have more current assets than long-term assets because current assets are more tangible and they can be liquidated easier. So not that much inventory though, which is great because we don't want them to have a lot of inventory because we don't want them to need to have a lot of products stored for them to sell them, so that's great. Uh, then not that much cash, which I don't like, and basically nothing really major. They have no short-term investments and a few receivables. Let's go to liabilities. So if you go to long-term debt, this is what I hate about this company. It just has so much debt. But thankfully it's long-term debt, which is better than current debt. But still a lot of long-term debt, and it has more the long-term liabilities than short-term liabilities, which is good. But as I already said, at least half of the liabilities, entire liabilities, is the long-term debt, so that's very good. Right? Uh, and then basically nothing out of this chart. There's like this other long-term liabilities and other current liabilities, but nothing really jumps at me here. So let's go to the debt to free cash flow to cash on hand. Okay. So they got a massive influx of cash in COVID. But it's going down now. It's returning to normal. The free cash flow really had a dip too, but the debt is going down too. So pretty nice. But they did have to take out a lot of debt here for some reason, so not terrible, but could definitely improve. Now let's go to the profit margin chart. So with net income, the situation is actually pretty great. The net income is pretty steadily growing, right? And the profit margin is really in the same range for the past 8 years. So really nice there. It's just slightly going up from 16 right now. It's 16.88. It had a dip in 2019 and then the influx due to COVID, but it's now about 17%, so pretty great profit margin there. Now, the free cash flow margin, on the other hand, you can see that revenue is pretty much just gone up to this level, and the free cash flow has dipped. So I'm assuming they are either investing a lot or doing other things, but we'll have to check on that a little bit later. For now, let's move on to the discounted cash flow model, and let's see what we think the company is worth. So, since they have 4,000 here of free cash flow, I'm gonna make it a growth rate of 20% for the next 2 years, so that we get back to about last year's level, and then I'm going to go with a 2% 5-year growth rate and a 1% 10-year growth rate. That may seem extremely low, but that is basically the average growth rate of 3M for the past 10 years. So not as high, not as low as you would expect at first glance. Now, according to the calculator of WACC here, it thinks that it should be at a discount rate of 7.22%. First of all, let's put it to 8, and we can see that the value that we've calculated here is 140. But this is pretty much the best case scenario here. So let's say that that the discount rate will be 9% and that they will only grow at 15%, and this is much more likely to happen. And as you can see, the discounted cash flow per share, price per share, is 104. So just about this. Of course, we need to just about the current price. Of course, we need to add at least a 10% margin of safety. So for me, the buying price is around $95. I hope it gets there. It's not looking terribly amazing, because if you look at the charts, you can see that recently it's gone up, and there's a lot of resistance here, support, and we're going to see where that heads. Okay, let's go to the fundamentals. First of all, I want to see what the simple chart says. Okay, so just about, yeah. Okay, so you can see that really 3M is poor on the growth end, but really good on the sustainability end, which is great. The dividend is not that great considering that free cash flow has dipped recently, but we're going to take a closer look at that. The valuation is actually not really there, but we're going to see, right? The financial health is also pretty poor, apparently, but let's just take a look at why it's so bad. So growth, of course, there's no growth in revenue, there's no growth in the 5-year net income, and there's some growth in the profit margin, as we already discussed. Of course, the free cash flow dipped, which, yep, but also, of course, the 5-year free cash flow margin, but we cannot really count this one because of the dip here. So, but yeah, of course, the growth of 3M is not that good, right? So shares outstanding growth, minus 4%, which is great. The 5-year ROIC, as we already discussed, is really good. The return on assets is also pretty nice. The 5-year profit margin is 16%, which we want to see at least 10%, so that we know that the company has some room for inflation. And the 5-year book value growth is very nice, I have to say. Okay, now let's look at the financial health. So, of course, the liabilities compared to the assets, both check marks there, because they have a lot more assets than liabilities. But let's see what they don't have. So, as I already discussed, the debt situation is pretty poor. So these three are basically the debt metrics, and they just don't work. But they're almost there. Look, the debt to 5-year average free cash flow is, we want it to be below 3, but it's actually 3.07. So almost there. And let's go to the valuation, right? So price is below intrinsic value, which is 107 according to my tables before, but as we calculated here, it's 104, which this value was calculated, is what I calculated before this video. And so you can see that pretty similar rates is what I must have inputted. The price to book value is 4, but as I said, with this big of a company, it's not really that bad. The 5-year price to free cash flow is 16, but that's because the recent free cash flow dip. Okay, these two valuation metrics make a lot of sense, except when the stock price is really high and then it dips and you want to buy here. You should not be looking at the 5-year PE and the 5-year price to free cash flow, because that's what happened here. But right now you're buying here, and that's why it is important to look at the PE right now. Of course, if the company had an influx of cash in the last year, then this might be a little bit unreliable, but of course we know that with 3M the rates are very stable. So now let's look at the dividend. So 3M fulfills the dividend rate of a notable dividend and a high dividend, because their dividend is almost 6%. And also their net income payout ratio. Unfortunately, since their free cash flow dipped, they do not fulfill the free cash flow payout ratio. But the 5-year dividend growth is there, but it's not 25%, which is what we want, but still not bad. So this chart is a little bit bad, because is a little bit unreliable, because the growth should be about here because of the free cash flow that dipped, or maybe even here, and the dividend really should be here because of the free cash flow dip, and also this one because of the free cash flow dip, and the valuation I cannot say anything about that, but maybe the book value could be a little bit higher, so maybe it could be here, and overall the chart would look more like this, which is a lot better, but cannot argue with this chart. So let's move on to the last chart of the price and the book value and the intrinsic value. So as you can see, the intrinsic value has grown from 83 to 107, and the book value has gone from 18 to 26. Of course, everything is growing nicely, but the price has actually gone down, and that signals to me that here 3M was a lot overvalued, great stock, overvalued, but now it might start to be a nice opportunity. So my opinion on 3M is that it is a really good company, but currently it is not worth what I think it is worth, is not selling for what I think it is worth, and if it goes below 95 bucks, I will definitely buy it with a small position, and then if it dips below like 80, I will go in with a lot more cash. But that's my opinion on 3M, and I hope you enjoyed this video, and I will see you next time.